Good evening, everyone. Hope I am audible. Thank you, everyone. Thank you so much for joining the first webinar of Fident. The idea over here is to present what we see this market going to be for this calendar year, and how are we seeing things across macroeconomy, across different asset classes, across different markets, and especially Indian equity market as we speak. So we will just, without giving away any delays, we'll start here. So what we understand that 2024 was a year of SMID, where basically we saw Nifty giving a return of 8.8%. But if you look at broader market, the return was pretty healthy. BSE 500 gave a return of almost 14.5%, but when you look at the mid caps and the small caps, they gave a return of almost close to 23.5% return. And the segment which stole the show was microcap, which gave a return of 33.5% in the calendar year 2024. But when we saw the start of this calendar year, things completely changed. It started changing toward the later part of 2024, but it's become completely a mirror image of what we were seeing in 2024. Broader market actually started underperforming compared to large cap. Though it's a very limited time frame, but the start of the year was not all that great for the market, where we saw not only BSE 500 going down 3%, almost 2.5 times higher than what Nifty fell, but look at what mid cap, small cap, and micro cap did in a span of a very, very small period of time. And the reason we all know is due to the slowdown in the economy visible, due to the cut in the earnings, the relentless selling by FIs, strengthening of dollars, and uncertainty because of the Trump election and things like that. Now, when we come to it and try to understand what actually happened, we present to you this very interesting data point. There's always two elements to a return for stock market. One part is earning, and we believe stock prices are slaves to earning. Second is the sentiments, the re-rating and the de-rating things. So if you see on your left-hand side, the green bar is the return of Nifty 50, where you can see that it gave a return of 8.8% in calendar 2024. But if you look at the earning growth during those 12 months ending December 2024 was a strong 15.8%. So there was an calculated, or I would say minus 7% adverse impact of derating which happened in Nifty 50. If I just go a year back in 2023, we saw a return of almost your 20%, where the earning growth was only 12.8%, but your re-rating or the sentiment positive contributed to the your Nifty 50 return of 7.2%. If we combine these 2 years, actually we will see that the impact of sentiment is more or less nullified, and market has actually mirrored the return what it has delivered in earnings for those 2 periods. When we come to BSE 500, here also the story says the same. Your BSE 500 returns is also led by earnings. In 2024 itself, BSE 500 gave a return of 14.5% in calendar 2024 from January to December 2024, and your same earning growth was close to 14.1%. But when we go back in 2020, there was an element of re-rating, which we witnessed was 7.3%. On top of the earning growth of 17.5%, we saw a strong return of 24.8%. So when we look at this data, I believe this data gives a very clear-cut indicator of where the market is going ahead. Already Nifty 50 has seen a negative impact of derating. If you look at forward of Nifty, it is now trading at almost 19 times earning of 26. It basically says that a lot of the froth which we were about to sow building up in early 2024 and late 2023 has been completely washed out. But when we come to the broader market, it's slightly a bit tricky, which we'll see in the later slides. If I look at the same data over a long period of time, say 5-year period of time, you see at the left-hand side, you can clearly see Nifty 50 gave a return of almost 14% in the last 5 years. This is from FY19 to FY24, whereas the earning CAGR was close to 17%. So there is an actually annualized 3% derating which we have witnessed in Nifty 50 over the last 5 years, in spite of all the broha that we have witnessed in the market. But the case is not the same for the broader market. If I look at small cap and mid cap, the 5-year CAGR return is close to 26% and 27% CAGR, where the earning has been supported to the extent of 21%, close to both. So there's a 5% re-rating element in this case of small cap Nifty, and in the case of mid cap, there is a healthy 7% correct contribution from sentiments. This number looks a bit lower for BSE 500 at 3%. Now we have to understand this that these numbers are at the end of December 2024, where we have already seen 6-10% decline in those stock prices on indices level. Individual stock have gone down 20, 30, 40%. So one thing which you have to take it from this slide is that in the broader market, there is a good element of positive sentiment still reflecting in the market. And when we say that this is an year of selection, which we'll come to in concluding slides also, that we have to make sure that this sentiment contribution stay put. We will have to see that the earning momentum of this broader market businesses stay put in the coming year. That is calendar 2025. Now, a lot of people were asking us, Ash, whether mid cap and small cap is a place to be. Is it a time to book out? How do you see valuations going through? Should money move from mid cap, small cap to large cap? So we thought of putting up the data and trying to see what the data says us. Now, when we saw if you see the last 5 years, as you saw, the earning trajectory in the broader market is much more robust compared to large cap. Whereas mid cap index has given a CAGR of 28%, small cap has given a CAGR of 19%. Nifty is sitting at 18% kind of a number. And even forward, when we are trying to see the consensus number, Street is expecting almost 20% earning CAGR for Nifty Mid Cap 100 and almost 18% CAGR for 24 to 20% for small cap index. Whereas Nifty 50 earnings are slightly muted. Now, if I take this data and see how the valuations are looking through, mid caps are trading at steep valuations to large cap, that is Nifty 50, with almost a premium of 58%. Whereas small cap is trading at almost a valuation 20% premium to large cap. So what we understand from this part is obviously the earning visibility for the broader market is definitely higher, right? There's some pockets, some segment where we might see some pressure because of this economic slowdown that we are witnessing. But larger chunk should be able to drive good earning to maintain that kind of performance that we have witnessed. But the chance of doing any error is very, very limited at this point of time. So when we say 2025 is the year of selections, if you want to play through mid and small caps, you have to be very sure that you're playing those earnings very, very clearly, and those earning resilience will help you to create those alpha, at least in this calendar 2025. Now, this is a lot of people ask us that, what really changed? Economy is doing well, political stability is pretty solid. Why are FI selling out? Why we're seeing pressure on the market? I think these two slides will tell you about what exactly went wrong. By June, July, we were all doing great, and then we started seeing the quarter two number. Initially, the quarter one number of FY25, we saw an EPS cut of almost 2 to 3%. Market shrugged it off, said, okay, now that's fine. We always start with a high hope of 15-16% growth, and then there are always some tweaks which happen across when we cross that way. But after quarter two, we saw that no, there was a deep cut, and cumulatively there was a 4 to 5% cut in quarter two, and stock prices started reflecting that valuation cut which happened. And we saw market gave up almost 16% return after September or onwards. And we saw the FI continue started to sell Indian market, obviously because of valuations and things like that. And then, the Trumpification happened when Trump took over. The whole narrative, the nationalistic movement in US started building up. And to make America great again, this become a case of dollar strengthening, and majority of this emerging market currencies started to see a lot of pressure. And at the same time, we also saw that yield moved up. So there was a kind of a risk of sentiment which played, and it's accentuated with the FI selling, and we saw Nifty falling almost 12% from their peak. But when you look at, when we are interacting with companies, hearing them out over the last 6-7 months on the various con calls, the word slowdown is pretty relevant now. When we see the company's communications, this question has been normally been asked: how are you tackling with the word slowdown which is there? And that also created, put a lot of fire in the furry about the market taking a backseat, and especially the broader market, which is more related to how our macroeconomic does. Now, second thing, most important, obviously, FI has been under completely a selling spree. We will come to those data, and there's some interesting observation that we had. But this is how the MSCI look like. The MSCI is India, which is almost close to more than 150 odd companies. And when we try to map it with the valuation that we are standing right now, and compare it to the last 15-year average, that what FIs are looking at, we came to know that only there are two sectors which are anywhere close to the long term average. One is financials, another is energy. Majority of the other sectors are anywhere between 10 to 40, 50% premium. And with the initial selling that we saw happen in majority of the sectors apart from financials, and then the selling catch up, and these sectors were also got a part of gotten medicine of being sold left, right, and center. At the same time, we saw our real GDP, the GDP growth, the number were revised by the government. We also saw a spike in inflationary trend in October, November, and all this has led to dispersion, which led to that. Okay, there will be two set of companies, one or the sectors, which will possibly wither the economic disturbance which we are witnessing, and continue to show us cash flows, continue to show us earning growth, be very efficient on capital. And others were which, basically were who will become a victim of the whole slowdown story. And then those are the ones which are to be basically avoided. This would be the year where basically you just spray and pray that okay, we will be making money. And we didn't don't believe that that will be the case. You have to go back to the your boardroom and go through all the numbers on what you think should work through, and those sectors where we will believe that there will be a resilience of earning, there will be a resilience to the growth, will possibly be the one which will creating wealth. So we have will be coming to some of the sectors which we at Fident think that they will be able to create wealth in this calendar year. We'll go through it in the coming slide. But before that, I want to bring to your focus that what as an DI or the domestic investors are looking at, right? So if you look at this earning EPS earning growth, and we spend a lot of time and energy on earnings and cash flows here at Fident, because this is what we say that drive the market more than sentiment. So if you have strong earning growth, your sentiments adds up, which we showed you in the initial slide, and this works vice versa also. So when you started this calendar year, market was at 14-15% kind of number on EPS growth for FY25. That number has come down brutally to 7%, and market is still sitting at almost 15% growth for FY26. So all the excitements are still there. Good segment of people believe that the pickup will happen in the second half of this calendar year, because things which are far off are relatively easy to decipher, rather than which things are which are very closer. We believe that there would be cumulative 10-11% kind of an CAGR growth for FF 25-26, but there might be companies who will be able to do much better earning growth. So we are not really keen to play nifty indexes through Fident, but we are inclined us to play the companies and their earning going ahead. Certain sectors which we believe should be able to contribute more earning in FY26. Obviously, one is industrial with the revival of capex. Healthcare is another one which we believe can add up to the earning growth whole trajectory. Consumer discretionary is the one which will remain pretty consistent. On the other side, sectors like BFSI, IT, consumer stable will bring the stability to the earning growth momentum which we are talking about. Now, here we are. Just want to give us how do we see that market will look like. So when we started our funds in early 2024, we went ahead and parked our money in IT when IT was not in favor that time. Similarly, we did it with pharma and protected our capital with BFSI and things like that. And that luckily have worked well for us. Now, trying to conceptualize how future look like, we believe that these are certain sectors which to us looks like that they could be the alpha generating sectors for us. Obviously, first is the pharmaceuticals. We believe that this is one area where we are able to see higher growth. And when we see right from US pharma, Indian pharma, or even if we go back to say, CDMOs and CROs and things like that, we believe there is a value propositions. Obviously, valuations is one have to be doubtful, we have to be careful about. But pharmaceuticals is one sector which we believe should do well in this calendar 25. Similarly, because of the capital goods and manufacturing is one sectors which has not been in focus. Even if you look at manufacturing as a percentage of GDP over the last 5 7 years, there has been a clearly decline in spite of all the right initiative government has been putting up. And even if you look at the private capex and the government capex, we'll come to those numbers later in our presentation. There has been an alarmingly slowdown there. So we believe over the next 2 to 3 months, we will see some recovery happening in this sector, and these sectors which are completely not in the area of interest for many of those investors will have a high probability of creating alpha in this calendar year. Power is obviously one which will be a bit difficult to make money out of it because a lot of has been priced in, but one have to be very, very selective in playing this long-term structural theme. And FMCG is another one which we believe which was completely out of the interest in calendar 23 and 24 could come back strongly. On the safety bets, I believe it's IT. We are very, very positive on IT, the way US economy is doing. And with Trump coming back, a lot of focus on emerging market currency depreciating. We are seeing what happening to, INR. So good US economy and weaker INR is a go-getter for IT. So IT would be able to get us a safety protection to the portfolio. Platform businesses, whether it are exchanges, whether it are RT agents, whether it is custodians, I believe the financialization and saving theme will continue to play out well in effect calendar 25 also. That will also be a part of our portfolios. And private banks, is one we believe have a lot of value propositions from a valuation perspective. Obviously, there's a slowdown in the credit growth. We have been witnessing the numbers. Obviously, Kotak did very good numbers. Access was likely muted. But private banks is a place to basically hide for this calendar 25. Now, if we just go deeper into the themes which we really like at Fident is obviously one is EMS. We believe this opportunity is huge. Out of I think India's market share in the global EDMS market is not even 3%, 3.5%. And the way a lot of these companies have shown up, like whether it's likes of Keynes or Dixon's and many others, which are completely in sync with the government initiatives of PLI, of RDSS, and the capabilities that they have generated. I believe EMS is one segment which will continue to do very, very well. And when you talk about semiconductors and things like that, I think a lot of these companies, especially Keynes and all, have been doing a lot of good work on PCBs and things like that. And I believe this is one theme we are very positive about, and we want to play this for the coming year. Second is obviously renewables and transmission. A lot has been talked about that. I think we are close to 200 in very simple word out of the 450 gigawatt of capacity of India. We are at almost 200 kind of gigawatt, which is renewable. And we are talking about a number to go to almost 500 gigawatt in the coming 6 7 years. And for that, we not only have to have this generation, but distribution and transmission and the whole value chain, I believe, has a huge, huge opportunity. It's a multi-year theme. And there are a lot of small, mid-sized companies which are doing phenomenal job trying to create value in the whole value chain. And I believe that is one area where we are very excited about, and we are playing many themes in this mega theme in our portfolio at Fident. As third one is, as I said, CDMO, when we talked about pharma, I believe last year was a tough one. We saw a lot of this funding being dried up, especially after COVID and things like that. But now we are seeing, when we're interacting with many of these companies, we are seeing an uptick in requests for quotations and things like that. A lot of these companies have created a lot of capex over the last 2 3 years. They have brought a lot of efficiency into the system, and whole with Trump coming back and trying to become more biosecure, though it didn't find its place in its initial office working, but we believe that having the China plus one is will actually work in pharma as a space. And CDMO is the place which can create good alpha generation for this coming calendar in this calendar year. Data center is a theme which we believe will work. We all know about digitization, and I think there's a lot of dependency on data center. There are not great companies in that particular sector to find out, but we believe this opportunity is used, and we are able to identify some names in our portfolio. We believe this uh, is basically where we believe this whole sector can go to 2 to 3 times in capex requirement in the next, say, very short term, 3 to 4 years. And there is one sectors which we don't want to miss it out. So I believe that is one area one should focus on. Another, if you look at more holistically, rural is a theme which we like. We have seen good monsoon, good rabi season, good water reserve levels that we have witnessed. And when we are seeing the numbers of some of the companies of the last 2 3 quarters, whether it is Marico and all that, they're showing good sign of rural recovery coming through. So last year we played FMCG with a very few selective names like so Mrs. Bacter and ITC, but we believe there is a time that we add up at least one or two more names in that team to play higher growth for this calendar year. Defense is another one which we believe that will continue to remain core focus area of the government apart from power and transmission, and the focus on indigenization, and the way we are witnessing tendering every 2 3 weeks. I believe it's a strong long-term structural themes, and a lot of the stock prices have also come back to some standard level in defense. So defense could be area where you can create some alpha there. One thing which we are playing very aggressively is batteries and component maker of batteries. I believe the increased adoption of EV over the last 2 years is very, I think, is unprecedented level. And with the launch of new products, new player like Honda coming out very aggressively, the requirement for domestic sale and battery manufacturing is huge, and we are able to find out really great companies in this field. So I believe this is indeed a theme for the next 2 to 3 years to play out. And last but not the least, I think water is one area which I think is the talk of the town. Like if you compare India to any of the other developed countries, the water waste treatment capacity in India is hardly in high single digit, 7 8%, where in most of the developed countries, the number is above 70 75%. Even in comparable countries, the waste treatment capacity is 20 25 30%. So India is way back. And when we are talking about splitting hydrogen and creating power, we are talking about semiconductors, we are talking about CDMOs and all of that pharma thing. We need clean water. So I think water is a theme which should play out for the next 4 5 years, and I think that area can create and provide alpha at least in this calendar 25 also. Now, this is what we like. Let's quickly cover on areas which we see have a limited upside. That's our own personal view. We believe that we will move out of small PSU banks. We are not seeing any sign of worry as so far, but obviously the way the credit system is slowing down, the evergreening of credit costs and things like that will not happen, and we might be able to see some dark phases in some of those smaller size PSU banks. So we will avoid that. Microfinance, we have completely avoided it last year also. We have no investment, and we will continue to do so going ahead. Interestingly, two-wheeler is a theme. In spite of we liking what is happening with rural, we believe a couple of investment that opportunities there in two-wheelers will not be able to create huge alpha at least for this calendar year. The reason is obviously with this commencement of new capacity from Honda coming on, and most of these players will possibly lose market share going ahead. And I would rather be more comfortable playing through auto and auto Inc. in that particular space. So we are very positive on EV, we are very positive on rural side, but I would not take that hyper competitive market to make easy money. So two-wheeler, we will be very careful in that side. And at the same time, we will be avoiding oil and gas. I believe metal commodities, because of the China slowdown, it's going to be very difficult. How the dollar will move, how China will act, how possibly US will act. So I think that provide a lot of volatility to this particular sector. So we will be avoiding this one. And real estate is one of the one sectors which we will consciously avoid. We had seen great run in real estate. If you see real estate volumes, if you see formalization of the whole sector, I think that thesis has more or less played out. So there's very limited upside left in real estate, and that's the reason we will be avoiding it in this calendar year. Now, quickly, what we believe at Fident that things will play out. Obviously, Trump is taking office anytime soon, and this is second term, so lot of volatility has already been there in the market. What we expect that Trump will do anything which will help America to shine. So there will be more rhetoric or more noise to do with China, and Mexico, and Canada. But at the same time, he understand he's a businessman. He understand that coming at one go can really derail the whole process. Inflation can pick up if you completely put tariffs. So it's basically inflation. Tariffs are not good for inflation. It breeds inflation, whether it is the ability to import and ability to export, and that would be the last thing he would want. So I think he should be taking very calibrated steps going ahead. I think we have been talking on this about how Fed interest rate part movement look like. The way the last 2 months, the way the U.S. yield has strengthened by almost 100 pips after the U.S. data and after the CPI inflation print, I believe the maneuverability of Fed to play out is very, very limited, and they will remain very cautious on how to go ahead about Fed on the interest rate cut. So I don't expect very severe cut going ahead. At most, say 50 to 75 bips of cut in this calendar year, and they will be more in a wait and watch mode. This alongside what Trump does will dictate the terms of the Fed interest rate, and that will also dictate how crude will look like. So, if we see the last tenure of Trump, we have seen lesser of geopolitical noises, and we hope that same continue. If that continues, then we will see some stability in crude prices. China's slowdown will be a determinant for crude, but we will have to be watchful of that part. I think the joker in the pack is obviously the currencies. If Trump comes and come out with a long list of tariff trades tonight or day after when he take office, we can see USD strengthening, and they will be putting a lot of pressure on emerging market currencies, and we might see FI selling continue. So that is one area where we will be watching it very, very closely. But I believe large part of the strengthening of USD is done, more or less. I think once he takes office, when that data is done, things will start normalizing. Quickly, I think, as I said, China, if you will avoid metal and commodities, China is, whether we like it or not, is actually under severe stress, especially on their housing and real estate. And that is the one bet which we will try to avoid and make our portfolio foolproof, that if anything goes wrong in China, we can't remain insulated out of it, but we should have a limited impact out of that. And last but not the least, if you look at RBI, I believe they have a limited room now to play through. We have seen erratic inflation lately. We have seen Fed deferring interest rate cut. We have seen RBI intervening and supporting currency, basically drying out our systematic liquidity. We already saw CRR cut. So I believe RBI will not be very aggressive in rate cut. There will be very hollow rate cut if Fed parts through, and the pressure of currency that we are witnessing is very dim probability of RBI going very aggressive on rate cut in this calendar year. And obviously, we have some state election, Delhi, Bihar in this calendar year, but we see very limited impact of this on market going ahead. Now, if I look at, this is what will dictate the terms, and this is what is very, very important for a broader market, for the mid caps and small cap, right? So as I was telling you that inflation remains the key driver globally as well as India. So if you see on the top left, your bond market is signaling higher inflation in US. And if Trump comes and put up a lot of tariffs and trades, that the probability of inflations to go up will be much higher, which will limit the probability of Fed to cut rate. If that happens, USD will zoom much higher, creating pressure on other emerging market, not only on the currencies, but also on the ability to cut rates. Coming back to India, as we saw, we have seen erratic inflation, but we expect inflation to remain in an accommodative zone for this calendar year. And we don't expect very sharp cut. Possibly another 50 pips to CRR cut is what I expect in the coming Feb meet, because it will bring liquidity where we are struggling through. We are in deficit right now, and that should help the market. Coming to the currency part, and I think which is very, very crucial, because whenever you see the last 15 years, whenever the currencies start depreciating in emerging markets, they normally do it for a longer period of time. So there is a trend that they follow. And this time around, obviously, we are hearing a lot on INR depreciation, but you'll be surprised to see that INR is one of the better performing currencies compared to many others. If you see on the bottom right, the data till December 2024, obviously RBI has intervened aggressively. We had a forex reserve of almost $705 billion before we see the debacle of emerging market currencies. We have seen it being wiped out of close to $80 billion or so. So that has gone in supporting the currency, but we have been one of the better performers going ahead. And as I said, what we believe going ahead for this calendar year, I think the dollar index up is has been more or less done, and I think it should revert back to normal over the next, say, 2 to 3 months, when we will have more clarity and stability of the government in US. Another thing, obviously, we had written a note on FI outflows in November, where we called out that this selling possibly will continue. And unfortunately, are seeing the same trend. We hardly saw almost a billion, less than $1 billion of outflows in calendar 2024. But we have already seen almost close to $4 billion outflow in those initial 18, 20 days of January. So we believe, because of this risk of sentiment, because of the strengthening dollar, slowdown in India, capex slowdown, earnings slowdown, this intensity of FI selling possibly will continue for at least 2 to 3 more months, since we have some stability about what Trump is all about for this calendar year. And the reason we believe that, the holding of FIs has been going down. Right now we're close to less than 17%, and that has been supported by the financialization of saving and the kind of inflow that we are witnessing in mutual fund. But we will be seeing this pressure at least for next 2 to 3 months before we see any change in guard on FIs. I think this is a very important data points. I think that is the reason we saw slowdown. We've been hearing about slowdown. When we saw the last budget, we are very close to budget this time around. We saw a number of 11.1 lakh crore from a figure of 9.5 lakh crore of government spending, that is called public capex. Last 2 years, if you see the 8 month spending used to be between 60-62%. This time around, I think it's because of due to the election, we saw only 46% of what was supposed to spend till November. And that slowdown started reflected in major economic part of India. I think now this we have very limited window to catch it up. Last year, of the amount of 9.5 lakh crore, we achieved almost 95% of that number. Previous year, we achieved 93%, 97% of the number. I think this year we would be very happy if we can do 92 or 93% of the what budgeted numbers of government capex that was announced. And obviously, we will see the new number in the first week of February. I don't expect that number to go materially high from here. A 10% number would be more realistic going ahead. No, data till December was not very encouraging. Let's see how the data for January and February picks up. But we have seen in 22, that same time when the number was close to 45%, government started spending and that number picked up. That can really give the much needed impetus to the growth of India. So the next 2 to 3 months is not only critical from India's growth perspective, supported by capex. At the same time, what will the global mindset changes after Trump takes over and Fed does with its rate? On private capex side, if you look at this data, this is on the left hand side, is a very interesting one. Our corporate to center capex used to be around 2 to 3 times till 5, 15, 16. That number has gone down to almost 1, which is like equal sharing of what corporate do, what compared to what center does. And when you look at the corporate balance sheet, we all know it's been deleveraged, and the profitability to GDP ratio will possibly go up above 5%. So we believe private capex will start picking up. A lot of analysts used to tell us that, if you remember, there was a time when deposit growth was just not picking up in the system. And then eventually the main reversion happened. Now we have the right macroeconomic indicators in the form of profitability, in the form of interest, ability to pay out interest, the deleverage framework. So we believe private capex will also pick up once we see this number of government capex spending out in the coming 2 to 3 quarters. Now, this is what all macro looks like. This is what we believe on how the broader market looks like. I think this is another one important slide, but I will ask my colleague Bhavin Jatania, who is the CEO of Fident, to go and discuss on this. Over to you, Bhavin.
Thanks so much, Ashwarya, and a big thank you to investors and partners for joining on call. So I just wanted to highlight one key theme in addition to the various points that Ashwarya highlighted on call, and that is really in terms of the IPO story and how pre-IPO opportunities have played out over the last decade or so. Now, this is a very interesting data point that we carved out in terms of looking at what is the value of market cap added by new issuances every year over the last decade. So if you see, there has been a consistent improvement in terms of new IPOs leading to addition to market cap of broader indices. So if you look at the years from 2021 to 24, those 4 years we have consistently seen a lot of new IPOs and large IPOs, most of which have done very well as well. So that has really led to an increase in market cap as well. To just give you a kind of single data point which we can take home in terms of how important IPOs have been in the last 4 or 5 years. IPOs that have come in the last 4 years, which is 2021 to 2024, today contribute almost 10.5% of the total market cap of India. And that's a very, very important size if you look at what has happened in the last 4 years. So I know we are talking of how we see 2025 and what are the various themes that we see, but we thought we should put this out and also, leave you with a theme that probably will persist not only for 2025 but for the rest of the decade. So if you were to ask me to zoom out and look at one mega trend, to my mind, I think this is the decade of the IPO, and pre-IPO opportunities will become mainstream over the next few years. So that is another very, very interesting theme. And what we also did in addition is just looked at these 4 years, 2021 to 2024, and double clicked on them to see if we could find any trends in terms of performance. And that's on the next slide. So if you see the performance of various IPOs, and we've just bucketed them into four quartiles, quartile one being the best performing, quartile four being the worst performing. Now, if you see consistently across periods, and this data spans across 4 years, more than 250 IPOs, which have been listed over the last 4 years, you clearly see a large divergence in performance. So from the most impressive IPOs, which are in quartile one, where the average return was 79% on listing date, to quartile four, where you see erosion of capital. So there being a 7% erosion on an average across these IPOs in the last 4 years. So what this leads us to believe is a very, very important point, that it is very important. And we've been talking about selection for public markets, but when it comes to IPO and pre-IPO opportunities, to our mind, selection is equally, if not more important, right? So that is one very, very clear trend that we see of IPOs and pre-IPO investing being mainstream. And at the same time, there being a lot of merit in being institutional backed in terms of selection of the opportunity, as well as looking at sizing and looking at access to a large institution as opposed to doing pre-IPO investing by ourselves. This trend, as I said earlier, we expect it to continue, and we've just mapped out few of the very imminent upcoming IPOs, which should probably hit the markets this year or early next year. And you will see a great blend, and it's great to highlight the range and diversity that you are seeing in various new companies coming to the market. So you are seeing, of course, newly set up businesses and few of unicorns in the private domain coming to markets and going for listings. You see some great traditional businesses also, which are up for IPO, which will really improve the depth and add to the further market cap that we currently manage under listed markets. Now, if I just move and link this to a product idea that we've been working on, which is very close to our heart, this is the product that we want to take to market very soon. but I took the liberty of sharing this with you, given that we are all logged on call. So this product is called Fident Unlisted and Listed Large Value PMS. We've created an acronym called FULL to just capture what the product stands for in a sense. If you look at the key features, and would love to take all of you through this product in great detail in the times to come. But what we are doing essentially is SEBI has introduced a large value PMS category, which gives investors the opportunity to access both listed as well as pre-IPO opportunities within one product. And that's very, very critical. So within one product, you have the ability to access our listed products, which we will come to in a bit, as well as some great pre-IPO opportunities that we keep identifying and curating for investors. The benefit that a product like this offers is, of course, you get the access of an institution, you get their views on various IPOs before they come to market, even at the pre-IPO stage. So it gives you a unique vantage point and the ability to participate in these IPOs much ahead of other investors. The other benefit of having a product where you can do both listed and unlisted is the fact that there is this ability to move between the two buckets very clearly, right? So, for example, if you see the start of last year where valuations were a bit punchy and we saw broader indices give by and large par returns, we saw a lot of private market opportunities do exceedingly well. So if both were to be managed in a single product, it's easier to be able to move and maneuver across both these buckets with much more ease than it would be for, say, a regular investor. And the last point which I would love to add is the fact that we both look at sourcing, ideation, and identification of opportunities. Plus, we also guide investors on making markets and creating liquidity for them when the time is right. And we would have, interacted and exchanged notes on various other large pre-IPO opportunities in the past, like NSE, for example, which at the time of investment were not very liquid, but today, thanks to the companies being more mainstream, are fairly liquid, and we are being able to make markets both ways to be able to facilitate better portfolio management for investors. Lastly, and this is to to kind of reaffirm what we stand for across our products. Our thought process always has been to first create these products, try this for ourselves, give you the proof of the pudding, and then take it to a larger audience base. That is exactly what we are doing in full. That is why we've not mainstream launched it. We are curating a couple of portfolios for ourselves, friends, and family. Once we go through that conceptualization and construction, we would be very happy to take this to a larger audience as well. So that was one theme which I thought would be useful to talk about, and the product idea that we've been working on. In addition to this, there are two products, as Aishwarya mentioned, which I would love to spend a couple of minutes each on and take you through what we have built so far. So, in terms of our investment philosophy, very clear, and you would have heard this, but I'll, for the benefit of you joining on call, quickly breeze through this as well. If you look at our investment philosophy at the core, there are four key pillars that are very critical to our stock selection and portfolio construction. The first is, of course, capital efficiency of the business. Now, this tells me how incrementally a company is able to generate value out of every rupee of capital. So we measure this through ROE, through ROCE, various different measures that we use, proprietary. But this is one very key parameter for us to use. The second is management competence. It's good to have a capital efficient business, but it is even more important to have this in the hands of capable management who can continuously derive value and run the business in an efficient manner. Third, we want growth. We are at heart investors who love to see growth in earnings, in portfolio investments across various of our investment companies, across various facets. So we love looking at sectors with high growth potential, and that growth should also translate to fundamental growth, growth in earnings, growth in cash flows, and so on and so forth. And the fourth, and probably the most important, is it's great to have the first three pillars, which is the hallmark of a great business, but we want a great business to be a great investment as well. So it's very important for us to get the first three pillars along with valuation comfort. We should have favorable risk reward. we should have valuations which are in sync with what growth we foresee for these companies. And that really makes our four investing pillar philosophy for all our portfolios to be created. Now, to just quickly zoom in on the first product, which is FAIR, Fident All Cap India Resurgent Portfolio. Very clearly, our investment framework is, as a lot of you use and are familiar with, uses what we call the growth and the value framework. So if you look at stocks, mutual fund portfolios, and investors, you see a very clear divide in philosophy between investors who chase growth and growth at any price, and investors who chase value, in the sense that they look at sectors, segments which are underappreciated, but because there are compelling valuations, they believe in value investing. Now, what we do is unique in the sense that we are not choosing one segment over the other. We have a very clear balanced framework wherein we are growth investors. So we will be overweight growth. Growth stocks will represent the core part of our portfolio. But at the same time, we will be very cognizant of value opportunities because we see a lot of opportunities for stocks migrating from value to growth, a lot of opportunities where we see tactical re-rating, and that adds the agile and opportunistic leg to our portfolio. So we will always be overweight growth, underweight value, but tactical when it comes to value. And the sum product of these two is that on an adjusted valuation basis, and as I said earlier as well, to reinforce our valuation discipline, on an adjusted valuation basis, our portfolios will always be in line with broader markets. So that's the GVA, the growth, value, and adjusted valuation framework for FAIR. Quickly moving on to the second product, and before that, just to give you a quick picture of what the portfolio looks like, this portfolio has now come to very close to its 1 year mark. This is what the portfolio looks like today. I would just want to take your attention to a couple of very interesting portfolio points here, and would love to take more questions on Q&A. But if you see the overall PE of the portfolio, it stands at about 34 times vis-a-vis 25 for broader markets. But if you see the EPS growth of our portfolio companies, we are looking at a 25% portfolio growth vis-a-vis 15% for broader markets. So on a earnings growth adjusted basis, our portfolios are lower than the index, which gives us the comfort that there is significant headroom for them to grow and perform in the future as well. The other thing which we spoke about, which is capital efficiency, is also clearly visible. So the ROE of our portfolio companies is inching very close to the 20% mark vis-a-vis 14% for the benchmark. And the best part is that this ROE is coming with even lower leverage than the index. So our debt to equity ratios are significantly lower than the broader benchmarks. So with this as background for FAIR, I'll quickly jump on to the second product, which is fiber. And you will see a lot of themes on this chart resonating with what Aishwarya covered in terms of the themes and the opportunities we like. So this is a clear portfolio where we've had a single focus in terms of theme of just following the government blueprint of development. The growth that we've seen in the last decade from 2014 to 24, we've seen few sectors, we've seen few sub themes do very, very well. And we expect for the current government term from 2024 to 29, for these 5 years, we expect these six sectors and themes to be at the forefront of all reforms. So utilities, infrastructure, renewable energy, manufacturing PLI, housing, startups, new age businesses, platforms, which again Aishwarya had alluded to earlier. And the sixth, any beneficiaries of regulatory changes or efficiency improvements. So these are the six themes that we are capturing through fiber. Now, if I take you through to the portfolio, it will make for a very interesting view. Now, if you look at the portfolio, and we've just put across the top 10 holdings, both our portfolios at all points of time will have anywhere between 20 to 25 holdings. There is zero overlap between both our products. So that's very clear. Both are very uniquely curated and clearly identified universe exists for both of them. Now, a lot of these companies you will see not being representative in larger schemes or traditional products. And that's very, very important. It's a testament to our research, to the amount of work that has gone into creating fiber. Uh, to kind of give you a sense, we spent almost a quarter conceptualizing fiber, meeting management, researching companies, doing plant visits, interacting with few research houses. Most of our stocks in the fiber portfolio actually don't have large research coverage, so we've had to get our hands dirty. It's been a great learning experience for us as well in terms of interacting with these managements, trying to understand few of these niche areas which we think will be great sources of alpha in the times to come. So if you just go to the portfolio quants for fiber, and this is worth a mention, so I'll maybe take a minute before we open up for Q&A here. Now, it's interesting to see the portfolio growth of both on a past basis as well as on a future projected basis. So if you look at FY21 to 24, for our current portfolio, the earnings have compounded by 48% CAGR, vis-a-vis 25% for BSE 500. So almost 2x of the growth of the benchmark is what has been witnessed by our portfolio companies over the last 3 years. For the next 3 years, 24 to 26, we expect the same trend to continue. So we are seeing a 36% earnings growth for our portfolio companies, vis-a-vis 13 to 14% for broader markets. Again, if you see on a growth adjusted basis, our Ps for fiber as well are significantly lower than broader benchmarks. And there is a little bit of noise in the data when you look at the overall P of our holdings. As you saw, few of our top holdings like Zomato, couple of other names are making the switch from loss to profit, because of which the P looks artificially higher. But as you go forward a year and a few quarters, this P ratio will rationalize significantly. And again, the hallmark of us liking low debt and high capital efficiency businesses is visible here as well. So significantly higher ROEs vis-a-vis benchmark with a lower debt to equity ratio at a portfolio level. And if you see the market cap segmentation for fiber, I think it's a little futile to look at market cap, because this is essentially a bottom-up constructed portfolio, but it reinforces what I was saying earlier in the sense that almost three-fourths of the portfolio is small and mid cap, which are names which we've worked very hard on, which are not usually found in other traditional portfolios. And there is a quarter of large cap, also simply because of the fact that they meet the theme. So we've stayed away from large benchmark indices simply because they don't fit into our six theme framework. So that's fiber for you. The last slide from me before I hand it over to Aishwarya back, to just see the proof of what we've created over the last year or so. FAIR was inceptualized on 19th April 24, and over the last 9 or so months, the product has done exceedingly well. And we take a lot of heart from this performance because A, this is a flexi cap index aware portfolio with a very high median market cap. But the last few months have been fairly challenging for markets. And I think the test of a portfolio or a manager is really seen in a market where you see significant volatility and downturn. So in that period, both portfolios have done exceedingly well. Fair has outperformed since inception by about 9.5% absolute, and Fiber, which was started in June end, has beaten benchmarks by about 11.5%. Both products have BSE 500 as the primary benchmark. We've also populated Nifty returns because investors are used to comparing performance against Nifty. So that's a quick brief from me. I would love to hand it over to Aishwarya to just take you through a little bit more about how these portfolios have done, what worked for us and what did. Over to you, Aishwarya.
Yeah, thank you, Bhavin. So just quickly, couple of slide left. Is one obviously when we see this 9 and 10% outperformance since we started, almost 9 months and 8 months so far. So what worked for us is that we went overweight in some sectors like healthcare last year. I think IT, as I said, was one of them which really worked in our favor. Platform businesses, talking about whether it is BSE, whether talking about CDSL, KFin Technologies, added a lot of alpha for us in calendar 24. Uh, what also worked for us is EMS play, as we said, and we believe that segment continue to do well. And some of the chemical names which worked for our favor were like Neogen Chemical. On EMS side, we were investors into Dixons and Canes of the world. certain CDO and CRO companies like Suven Pharma and all have also added a lot of alpha for us over the last calendar year. What didn't work for us is, we were very positive on BFSI last year, but majority of this large private banks which we were holding didn't added up a lot of alpha for us. But I think that was more or less offset by the kind of return we made from exchanges and RT agents and custodians of the world. And we completely avoided micro cap last year. We were not very comfortable with risk reward perspective. We were had only was one exposure to auto names in the form of TVS. We didn't have played a lot of infra stories and all of those high risk bet because we thought we are able to create alpha with lesser risk. Let's better do that rather than go in and charting out into this tougher area to do that. And I think this is the last slide we have. I think that is what why we say this 2025 will be a year of selection. If you simply look at, you obviously saw the performance of the portfolios. They've been adding almost 9-10% alpha. The logic is very, very simple. The businesses that we are owning are doing much, much better on revenue, cash flows, and earnings. If you see the last quarter which went by, your BSC 500, which did almost 6.5% kind of growth. Our growth on revenue, we our portfolio both fair and fiber did 13 and 20% year-on-year growth on revenue. And look at that PAT number. BSC 500 PAT last quarter was flattish. Fiber did a 28% whopping PAT year-on-year growth number. Even fair with a higher allocation to large cap were able to generate 10% number on PAT. Same goes for the EBITDA. That is what we believe will be the reason for the outperformance the Fident funds are showing. And going ahead for the next couple of years, we believe that these portfolios will be adding higher earning momentum compared to what BSC 500 is expecting. And not forget, these are just consensus number. Possibly they will go for revision what we saw what happened in 25. We haven't seen any earning cuts in our portfolio companies after quarter two. That is pretty reassuring us that you have an ability to identify those 2025 names with a higher growth potentials, which even can create alpha for you in tough times like this, which was visible in the last 6 months. So I think we will stop here. That was the idea of sharing us what we feel this year look like for the investor community and what are the ammunition that we will be carrying to fight out this year in creating alpha. So I think we can take question and answers over here before we call it a day. Over to you, Bhavan.
Thanks, Aishwarya. Really appreciate your time on the call. Please use the Q&A tab on your Zoom screen and please type in your question. We would love to take your questions and queries. And if you're facing any issues, please raise your hand so that we can unmute your line or take your question offline and project it on the screen. We'll wait for a minute for questions to assemble. And while we wait for questions to assemble, I'm pleased to share that two of our senior research analysts, Mihir and Pawan, are also logged into call. So if you have any queries on sectors or particular holdings that we have, we would love to have Mihir and Pawan share their views and interact. In fact, Pawan, the first question that we see is on HDFC Bank. So maybe while we wait for the questions to assemble, we'll start taking them in the interest of time. Pawan, this is for you. I'm just relaying the question for everyone's benefit. It's good to see HDFC Bank as your top holding in FAIR. How do you see earnings playing out in the next couple of years? Do you see it coming back to high teens growth? And a more generic question on which are sectors which we would avoid and the expected churn in our portfolio. So maybe Pawan, you can help us with the response on HDFC and over to Aishwarya for the negative list and the churn in the portfolios.
Hey, thank you everyone for joining us. It's really heartening to see so many participants on the call and then interacting very well. So on HDFC Bank, we are fairly confident. So it was always a question of when and not if. So we do think that the earnings will improve. Like, so as management has, HDFC Bank management has guided, FY25 will, they will be growing at a pace which is slower than the industry. FY26 is when they will be matching the industry growth. FY27 will be when they will be growing ahead of the industry. But the great thing about the HDFC Bank is that they manage the asset quality very well in any of the given cycles. They have done that since 2000, and we continue to believe that they will be able to do that in the current cycle also. So FY26 second half and FY27 is when we will see the earnings being ahead of the industry or higher than the mid-teens. That is how we are looking at the valuation re-rating also should happen 6 months prior to that. That's how we are looking at it. Aishwarya, you can take the second part.
No, so I just to give a view, I think HDFC Bank to me is like ITC 2.5 year back. So where people were expecting the running momentum to pick up. I'm pretty pleased to see the last 2 quarters update, the way their LDR and LCR numbers are moving through. We all understand that this has become after the merger. Then it's not pretty easy to come to the number where we investors are used to, and it will take its due course of time. What Pawan said. But I believe that there's a lot of value in this particular name, and I believe that this is an opportunity which can possibly work to add alpha for our fund in the coming, say, 4 to 6 quarters. Coming to the other questions which Bhavan asked, what is the expected churn we believe? So we normally don't believe in churning around much. Since we have started, our churn would be close to 15-20%. It will be slightly higher in fiber because there we have to be very clear that whether the thesis and the themes are working out in that particular way we want them to work. So if things are not playing out, we will not wait out and try to see that we can put that capital to work at better opportunity. If I say there might not be just, I think, one or two exit that possibly we have done where we think we made money quicker than what we thought we will and took that money off. So eventually 15-20% kind of a number. And as you say, the negative list, obviously we have a long negative list. We normally avoid company sectors with not that great corporate governance standards. So even something which we like say infra or real estate, we are not very comfortable putting capital at work in that area of because of, as I said, the 4 pillars that Bhavin talked to you in detail, where we find all of these 4 ticking through. We are also not here in PMS to be playing out commodities very often. Idea is not to gain those quick 20-30% kind of a return rather than playing those 20-30% CAGR return is what we are more interested into. So commodities is also one sector which possibly we will be avoiding until unless an opportunity is screamingly hot for us or something in cement or something comes through. So those are the areas which we will possibly avoid. Over to you, Bhavan.
Thanks so much, Pawan and Aishwarya. The next question, your views currently on two sectors, chemicals and BFSI. So for chemicals, maybe Mihir, you can share some thoughts, and then over to Pawan and Aishwarya for BFSI.
Yeah, sure. So first of all, on the chemical side, we are seeing chemicals like having a down cycle of at least for the last 3 years, we see the down cycle primarily led by agrochemicals. So just for context, agrochemicals is almost 75 to 80% of the chemical companies listed in India have agrochemical exposure. So a downturn in agrochemical cycle affects the entire industry, and that's where we've seen the stock price is going nowhere in the last 3 years. They are actually some of them are at least 50 to 60% lower than their all-time highs 3 years back. Going ahead, near term, do we see any green shoots in the chemical segment? I do not see any recovery, at least for the next 1 to 2 quarters. Why I say that is when you track the export data and along with that the chemical commodity prices, there hasn't been any green shoots whatsoever there. And when you correlate that with the global agrochemical innovators recovery happening, it looks like the recovery is still 2 quarters. We still don't see that happening in the next 2 quarters. However, we see FY26 to be very, very strong for chemicals, and there are two major data points which we kind of are tracking, and we see that recovery will continue. And then post that, we'll see 2 to 3 years of good chemical cycle coming there. So if you look at segments which saw pain much earlier than agrochemicals, something like dyes and pigments, something like pharma, intermediates, API, we've seen recovery happening. So this their down cycle started 6 months to 1 year down the line, and we've seen recovery happening in the last 3 to 6 months. We expect agrochemical to kind of track this, and the recovery will be there in 6 months to 1 year. In terms of how our portfolio is positioned, our portfolio earnings, especially what we own, have been very, very stable, materially outperforming on the earnings front. So something like a Rosari, which has seen stable earnings for the past 5 to 6 quarters. Something like a Styrenix, where the spreads have been relatively stable and volumes have been kind of picking up. Something like Himadri, which has been the outlier for the past 1.5 years. So our portfolio is much more positioned, is very well positioned in terms of earnings. We've not seen any earnings downgrade in the portfolio company which we do. Uh, and we see a much positive outlook for FY26 going ahead for the chemical sector, and especially the companies which we own.
Coming to banking and financial services, within banking, so there is clearly like a slowdown in the deposit growth and the credit growth that we are seeing from the industry numbers that are put out by RBI. We think that is going to persist for at least 2 quarters because the liquidity is not being used anywhere. Like the way the RBI is selling dollars, taking out the liquidity, and then the government capex has slowed down in H1 because of the elections. So we do think that it's going to take at least 2 quarters for the growth to come in terms of the deposits, and also which will translate into advances at a later stage. Uh, but we are not so much concerned about asset quality. While the growth will be slightly slower, but particularly if you look at the corporate banking results that are being reported by PSUs or the large corporate banks, there's hardly any stress in corporate banking portfolios. Coming to the retail banking, there is some stress in unsecured, which is personal loans, credit cards, and then MFI. But the impact on the banking sector is not going to be that much. Uh, even the banks mentioned that there is a little bit of stress, but not alarming. Like we are not going to see pre-COVID kind of a credit cost in the banking sector anytime soon. So when the cycle turns, when the deposit growth accretion happens, I think the banks will pick up well. As I said in the earlier question, in H2 of the financial year FY26 is when I see the growth coming back in banking space. Coming to NBFCs, it's like home finance NBFCs will continue to show a tremendous growth, north of 30%. Similarly, the small SME financing companies will show similar growth. Vehicle financing companies will depend on the auto. But one positive segment we are seeing is CV financing. As and when the rate cut happens, even if it is a shallow rate cut of 0.5%, we think companies like CFC will do really well in the second half. That's how we are looking at PFC. Yeah.
Thanks so much, Pawan and Mihir. Just moving to the next question. In terms of sectors like power and renewable, where do we see value and which are the names that currently look interesting to us? Aishwarya, Pawan, maybe if you want to take a crack at
I
it.
think it's Pawan's favorite area. I think he spent this professionally more time in identifying this name. Just before he, so I might think, as I said initially in my initial comments, I believe power is where the government is putting the highest focus on. And whether it is renewable, whether it is, as I said, distribution, generation, transmission, and all the ancillary industries will benefit materially in the whole process. Now, the problem lies in valuation in this particular space. And there is a lot many companies who are doing phenomenally great job, but they're very little to take a call on that management because of a limited time frame is very, very difficult. And many of these companies have valuations are not pretty easy to play out. So one have to be very, very careful in playing out the power sector as a whole. Now we have two sect of companies. One, obviously, the old school traditional companies of generation and distributions and transmission over there. But last 3 4 years, we have seen a plethora of names coming and adding up who are doing something with photovoltaic cells or something on solar and things like that. And valuations are just completely out of sanity, if I may use that word. So that's why Pawan is putting a lot of effort to find out something in value propositions which fits our bill. But in short, we are very, very positive on power and as a whole. Pawan, if you want to add anything on this.
Yeah, so just one thing I'd like to talk about, like solar and green, like wind energy. These are the two things that government has been focusing a lot, which we all know. Wind is one sector which we are very, very positive on. Like solar, there is too much competition, but within wind, we see there are two Indian companies, Suzlon and Inox. Suzlon has like a 25-30% market share. Inox has 10 to 20, 15% kind of market share. They will continue to maintain that. And they are launching, larger and larger wind turbines. Like earlier, wind turbines used to be 2 megawatt. Slowly, they went to 3 megawatt. Now, Inox is gearing up to launch 4 megawatt next year. The sites in India, though they are inferior to sites in Europe, they can support the 4 megawatt kind of a turbines. So there is a lot of value that will accrue to these two players, Suzlon and Inox. Looking at the valuations, how the turnaround opportunity, or not the turnaround, I would say like the capital allocation improvement that is seeing in Inox, that's where we are heavily positive on. Solar, we think the sector will do well, but just the competition is very high. And the value chain, the way the PLI incentives are also being given to the companies, cell manufacturing, and then the ingot manufacturing is where the major value accretion that will happen in the coming years is our opinion. Uh, Bhavin, back to you.
Thanks so much, Pawan and Aishwarya. The next question is a fairly interesting one. So, sectors like AI and semiconductor, are we seeing any opportunities there? And are we looking at some global opportunity fund which can capture these? So maybe I'll come to the fund idea separately. But Aishwarya, again, anything on AI semiconductor where you see merit
Yeah, I
worth
think that's a
investing?
great question. And when we conceptualized about fiber as a scheme, these were the sectors which we wanted to go and invest into, whether it is AI, semiconductor, data center, renewables, EV, and things like that. And when we were doing our work, basically the homework on finding out those companies, we understood that there are not many companies who are doing anything closer to what we were looking for, right? When we talk about semiconductors or possibly AI, obviously AI large part has been comes under the purview of Indian IT. But when I talk about the AI, which like what we expected investors looking for, there's not much as an Indian investors to play through. So what we ended up doing was to play out companies which are doing anything closer to semiconductor or AI, right? So majority of the investment which is happening is through Tatas and other large players, which will be through unlisted entities. So we thought of playing it to give, just to give an example, the closest which we thought on semiconductor who is doing something closer to PCB was Keynes, right? And we went ahead and played Keynes, and I think we had a very good run over the last calendar year. So same way, we are trying to find out businesses which fits the requirement of the criteria which we are looking through, and who are a big player on this thesis going ahead on both AI. But to be very honest, on AI, we were not able to invest into any names apart from one of those IT names who are more inclined toward AI and SMAC. But not a very true pure play companies are available in India, at least for say. On to the other global fund, Bhavin, you can take it.
Sure. So I think it's a very interesting question. And I think I would like to take a minute and clarify our thought process behind creating products across various opportunities. I think there are essentially three things that need to be met when it comes to looking at a new product. And we place a very high bar in the sense that all three should be met for us to take a new product live, failing which we won't add to our product basket. One is, of course, we should see the possibility of there being a sustainable source of alpha. Second is our ability or our right to win in that space. So we as Fident should be able to create a key advantage or key benefit as opposed to the rest of the market. And the third is our ability to scale. I think those are the three questions which we keep asking ourselves before we take any product live. There are a lot of ideas which are on the drawing board, particularly to do with offshore investing. But at this point in time, we don't have a ready solution, so to speak. But if we come across something where these three criteria are being met, we'll be very happy to take that jump and introduce the new product to investors. There are a few single stock queries which I am choosing to take offline for the benefit of the larger audience. Just filtering through for any other questions. I think we partly answered this, but Aishwarya, Pawan, if there's anything to be added, particularly on the earnings and credit slowdown, do we see this as a structural slowdown or a one-off? Any concluding comment?
Yeah, so that is what we spent this whole presentation on, and we believe that this slowdown is for real, and it will have to see some good turnaround from the way government starts spending to pull this whole economy out of this getting and hitting the wall of the derailment of the whole progress. So what when we are interacting with a lot of this management and trying to understand their the view that they have about capex outlay and whatever interaction feedback that we have got from Delhi, we believe that this message has been clearly understood. And the next 2 to 3 months, we are going to see a lot of activity happening on the spending part. And the green shoots that we have visible in the rural sector and urban ultra, I would say discretionary part, not on the mass side, I think they should be able to help on the recovery side. But I think the street is now working close to 6.5, 7% kind of a GDP number, 7, 8% for this FY25 EPS number. And that's become like, the fact with which the markets participants are working. But I think the ability to disappoint from here onwards is pretty limited, if I may say so. So the expectations are not all that great. Now street expects 6.7, 6.8% GDP growth. They expect 12 to 14% kind of EPS growth for FY26 on a lower base. I think with the right set of spending, with the right set of new announcement on the budget, not expecting too much again from that perspective, more spending on capex than revex, being both fiscally prudent on your the deficit side. I think that should be able to do the work, and some focus on reviving the consumption as a theme should be able to pull us in a much more safer position from that perspective. Anything, Bhavin, if you want to add, Pawan, me on that.
Thanks so much, Aishwarya. Maybe we'll take one last question, and I really appreciate participants staying back and appreciate your queries and questions. Last one for Mihir, in terms of a recent development, Zomato results came in today. Any first cut views, feedback?
So yeah, so Zomato's result just came before the call. So the numbers were on the revenue side were fairly in line. No major surprises slash shocks. Food delivery was at 17% year-on-year growth. Grocery continued to do well around 120%. I think the street has been kind of spooked by the commentary by the management that so basically when you look at the grocery front, they had reached adjusted EBITDA break even in the last quarter. This quarter we've seen some increases in losses, but I do not see that as a structural issue. That's primarily on account of the sheer amount of dark stores which they have opened. So what usually happens is Zomato closer to 1,000 or dark stores. They'll probably reach around 2,000 dark stores by the end of next year. And when you open a dark store, you take anywhere from 4 to 6 months to kind of break even. Just the sheer volume of dark stores which they opened in the last quarter and the quarter before that, in the last 4.5 months, that's kind of taken a hit on the margins. Considering everything, considering all the competition, Zomato's profitability matrices are significantly ahead of all other companies. You take Swiggy, you take Zepto. Uh, Going ahead, considering that Zomato's food delivery business is a significant cash flow driver, and that can be redeployed much more efficiently than all the other competing players. We do not really see Zomato's current quarters as a big challenge. Uh, there seems to be a slight overreaction to the current numbers in the stock. The call, let's see what the management has to say on the call, but we do not see any material headwinds to the long-term growth story of Zomato.
Thanks so much, Mihir. With that, we come to the end of all the questions that we saw on the chat window. I'd just like to conclude by thanking you again for your time and patience on the call. And for any feedback on our products, please reach out to us or the investor relations team. We would love to interact with you and take your feedback as we keep building our client base as well as our investment journey. Thanks so much again. With this, we'll wrap up the call. Thank you so much.
Thank you so much. Thank you everyone to be on the call.
Thank
Really.
you.
Thanks everyone for joining.